All right, let's find out what you do like and get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so people listening to a value manager talk Canadian stocks will say, how come you haven't talked about Canadian banks at all? So this is where we're going to talk about Canadian banks. Your first pick, in fact, is a bank. It's Bank of Nova Scotia. Why that one? And is it the only one out of the Canadian banks that you like right now?
Those are all excellent questions. Canadian banking is exceptional. We have 5 big banks. We're virtually an oligopoly. You could almost say 6 big banks now because National Bank is growing really fast and coming up quickly. They're very much steady eddies. They're incredibly well regulated. We have one of the world's best regarded regulators. I mentioned that earlier today. They're very proactive. The Canadian banks all today have about a 13% capital, much more than most other banking systems in the world. So that capital gives them a buffer in any kind of market challenge. So the banks are great. They something like 68% of the time they outperform the benchmark. So they're great long-term holds. There is opportunity within them. We currently own and like the Royal Bank, TD, and Bank of Nova Scotia. Now Royal's just the class act. What more can I say? But it's rich right now. So, you want to balance that off with, a bank that's been more challenged of late and likely to come back. And we all know about the challenges for TD Bank in terms of money laundering issues in the U.S. and limitations on their business, which is more recent in history. But we also had challenges at Bank of Nova Scotia. And as a value manager, of course, I want to own the more challenged banks.
You're a sucker for it.
Have the opportunity to revalue themselves back and up. And so I'm going to focus in on Bank of Nova Scotia just because I think that potentially it's going to be coming back faster. And you can even see it in the 1 year and year to date, it's had a better return than TD. So, it's been longer in its recovery phase with its new CEO. At first people were really a bit nervous about Scott Thompson because he wasn't essentially a banker at heart. But, he had been on the board quite a long time. Bank of Nova Scotia is very unusual because it was the only Canadian bank who hadn't invested in the U.S. as their international. It had gone global. It had decided to pull back from global up into Latin America and then is focusing even more so on Mexico now. So they're doing this north-south corridor between Canada, U.S., and Mexico. They recently made an acquisition in the U.S. By buying Key Corp Bank.
A stake in it.
Yes. It was an equity investment, so it wasn't a takeover.
That's right.
Advantageously. I thought it was a brilliant investment. I mean, at the time, there was a lot of question marks about it, but they just didn't, I don't think the marketplace would have accepted them going into debt to do a takeover of a major bank. But the beauty of the timing of the acquisition of Key is that it was after Silicon Valley Bank had difficulty. The stock was down significantly. And because of that, they got to buy one of the larger top 10 regional banks in the U.S. At a good price. And the optionality of buying more of it to practice this north-south corridor thesis.
The Canadian bank sector, the index is at a record high. And there's this idea that you can really trade the banks within a range. And so I'm curious what you say to that when And when I say traded in a range, I mean a valuation range. And that some will say, some notes that I've read is it's bumping up against that valuation range that they typically tend to top out at.
And that's an excellent comment. So, for example, we are market weight banks. We are, a little bit overweight all the names because we don't own all the names.
Yeah.
But overall, we're market weight banks, and we're looking for an opportunity to take the bank weight up when there's a better opportunity to do so. But we've already got our ducks lined up about what banks we like the best. Oh. And you can envision more than likely that when we take our weight up, we'll be buying the more challenged banks than the Royal Bank, for example.
Challenge is how you describe the energy sector, but there's also people scream about the valuation and when is value going to be enough to bring people into the sector.
Yes.
You brought a top idea to us in Cenovus, which has really perked up. It's also thrown its hat in the ring in the acquisition for MEG. So I'm curious, what are the reasons that you like Cenovus here?
Well, we've been a little bit overweight the whole sector. And, I think I just want to step back. I mean, the oil and gas sector is now a dividend yielding sector. They've stopped going out there and doing lots of exploration. They've gotten the message that investors want them to get cleaner balance sheets. So their debt burdens have been dropping. They're focused on giving cash back to investors. So they've been giving out great dividend yields. They're doing share buybacks. They're just really cleaning up their act. So they're becoming a really interesting investment. The only big challenge to the stocks right now is the commodity price is a little bit off. It's in the mid 60s. And so down from the mid 70s. So that has caused the stocks to be a little bit on the soft side. We've just taken profits in some of the other names we had previously, and then we added in Cenovus, which had been kind of a laggard. But, some of the developments they've been investing in are coming to fruition. And so that we think that this has in any environment, it has a revaluation going forward.
Do you care if they get MEG?
And, I was thinking about that in advance and talking to my colleague, Alexei Wojcik, who covers the sector more deeply than I do. They're 4 times the size of Strathcona. Strathcona wants it to be all share because they want to increase their market cap. Cenovus is giving cash and some shares. And we suspect that they're likely to come back with another bid. And, it's a win-win for both of them. And in the end, I mean, Strathcona, owns 15% of MEG. So the price will be higher and they'll get, a windfall to a certain extent. But we suspect more investors will want to tender to a Cenovus with cash in hand. And a stock that's much more liquid, with 4 times the market cap overall.
And you like that as a Cenovus shareholder? You like the acquisition of MEG and what it does for you as a Cenovus shareholder?
Yeah, this is Cenovus is an integrated oil sands company. This will help the production side. It'll help ultimately, well, depending on what they pay, keep the costs. Help them get more efficiencies and have a future growth, which is important. They've been cleaning up their refinery side. We think it could be very additive. We had owned MEG. We thought it was a very interesting investment. It's a smaller cap stock. It's more volatile. It gives you these opportunities. So it's not like we dislike MEG at all. We have been a fan of it. So we just think that there's a recovery opportunity still in Cenovus, and a lot of their developments are coming to market now, and we are likely to see the harvest of that coming forward in the next few years.
All right, we'll see. It's a fascinating situation, and of course, we just had our interview with Adam Waterous, where he made the case for why he should have MEG, but ultimately, I guess it will be the shareholders who decide. Your third sector and idea are a pair of gold stocks, Agnico Eagle and Barrick Gold, which I find so fascinating. So just talk to me about, why now these stocks, they've run up so much. How do you think about still seeing value?
It's also interesting as a value manager that we own gold and that we're virtually market weight gold. And I also want to step back and say that gold is a very volatile sector. And in my 40-year career, this is probably the fourth time gold is racing to the 10% weight in the benchmark. So as a value manager early in my career, I wouldn't own gold because back in the day, gold stocks always traded at 20 to 50 PE multiples. Now they're starting to trade at 25 PE multiples. And 5 years ago, they were very cheap as a segment. So we are market weight gold, which I've never been my whole career. But I think there's bottom up reasons to own gold from a reasonable pricing perspective. And that turned out to be a good move because we've seen the commodity price move very directly. The stocks themselves have lagged the commodity price move. We think that there's more catch up in terms of that going forward. I think we've all seen recently gold going to $3,700 an ounce. So it's an interesting sector. And as a value manager, for us to be fully weighted gold is, in my mind, pretty, unique. But it's also a unique set of circumstances, especially in an inflationary environment where the commodity will tend to move with inflation as well.
It's interesting because, since you have been around for 40 years investing in the sector, when they were terrible stewards of capital, even in good gold environments. So it's interesting that you're owning gold at a time you rarely, when you almost never do, and you like the stocks.
And they're not indebted. So, the stock that everybody loves and everyone seems to need to own right now is Agnico, and we were in it, and we've been taking money off the table to buy Barrick. So you'd basically ask for a sell story, and it's a half sell story because it became such a large weight. It became a risk in our portfolio. We always try and manage risk, single stock risk. So we took some of that risk and we said, let's go find the challenged entity. And Agnico, just going back to that as well, it virtually has no debt. Let's get real on this front. So that's pretty extraordinary. It doesn't really pay a dividend. It is a gold stock. It's a 1% token dividend.
Yeah.
But it's just a classy operator. It sets expectations low and it exceeds them. Its all-in cost is a little over $1,000 an ounce. We know where the commodity price is. So, very profitable, efficient, well-managed. It's the go-to stock in the sector that people are very pleased with, and we are as well. But, it was time to take some of that exposure away and diversify. So we went to the more challenged bank, which is Barrick. And it used to be the leading bank, the leading gold stock in Canada. And it's had its challenges. Which recently changed its name. It's got more copper in it. Often gold is a byproduct for copper development. So you get the benefit of both commodities embedded in a Barrick overall. But it's a lot cheaper and has an opportunity to revalue upwards. And that's why we kind of made that overall switch. And then it's got a 2% dividend yield. And, it's a little bit cheaper than Agnico. So we just think it's more of that revaluation overall.
Interesting. You like the sector, so you're kind of rotating from winners to ones that have...
We also own Franco-Nevada, which has had its own issues, obviously.
But a nice recovery.
Yes, indeed. We had to be patient.
Kim, what a pleasure. Thank you so much for joining me.